Hey guys, in today's podcast, we're going to talk about mechanical trading, so trading using indicators and how to make crucial adjustments or what you need to know in order to make crucial adjustments over time to those indicator-based strategies. Check it out. I'll tell you what, guys, I love it when one of my posts sparks a lot of conversation. I post a lot on social media, and some of it is just shameless promotion to tell you that Tier 1 trading is awesome, but a lot of it is motivational stuff or just thoughts that I have that I think will be beneficial to many aspiring entrepreneurs and traders out there. After all, I first got started in, trading and social media was a place that I turned to for a lot of my education. And unfortunately, I found a lot of junk there. So my goal ever since I started teaching was to kind of even out the landscape, right? Promote some good stuff, some real stuff so that hopefully new traders can have a good idea or at least have kind of different thoughts before they get sucked into anything scammy or whatnot. And the other day I shared this post that said, price action patterns change over time. Really should say markets change over time, but price action patterns within markets, right, change over time. What works now may not work the same in next year's market. This is why it's important to be a skilled analyst versus someone that just knows how to follow a strategy. And I got a bunch of cool comments. I actually ended up doing a YouTube video on this as well, which is pretty cool. But I got a really interesting one today, and it said, how about someone who is developing and following a mechanical strategy instead of being good at analyzing price action? I would like you to cover this broadly on a Trading Coach podcast. So guess what? Your question has been received, and I am here today to give you an answer, even though I already responded to you on social media. These podcasts are usually scheduled well in advance, so I didn't want him to wait like a month before I had a chance to answer. But I thought it was a very good question because I am a technical trader, and I guess technical doesn't necessarily kind of sum up everything, but I am a price action trader. So when we talk about technical traders and mechanical traders, we typically think of like technical traders being traders that trade like price action patterns, candlesticks, while mechanical traders are ones that trade systems, like using lots of indicators, maybe programming it so it runs automatically. And you can actually be both, right? I'm a technical trader, although I use price action. I do have indicators on my chart. You could be an indicator trader that uses price action for say, an entry signal. So there isn't necessarily, you don't have to be one or the other. You can be this beautiful blend. But for conversation purposes, we're going to talk about the mechanical trader in this podcast as being someone that mainly uses indicators as their way of entering a trade. So it's not as simple as this in real life, but like a moving average cross. When the 50 EMA crosses the 200 EMA, that is my sign to buy. Hopefully you're not doing that, or if you are doing it, hopefully, or to sell, or I guess buy or sell. Hopefully you're not doing that. If you are, hopefully you have a lot of other filters as well. You should have a handful of indicators to kind of help you out if you're going to take that route. But the interesting question is, okay, so understanding that markets change, right? Price movement changes. And if the solution to dealing with this, to overcoming this problem, is to become a good analyst, if I am a mechanical trader, what do I do? And this stems one of the bigger problems, right? Part of this statement spoke about the fact that a lot of newer traders out there are simply looking for the answer, right? They are looking for the strategy, whether it be a fully mechanical strategy using moving averages and RSIs and MACDs and all this stuff, Bollinger Bands, or whether it be some type of price action strategy where they're just trading a double top and double bottom combination, something like that. The point is that a lot of traders are looking for the answer where the solution lies in the hard work. Where if you can be a skilled analyst, you have the skill of understanding price action, understanding a price chart, and having that skill will allow you to see the small things that are necessary to change in order to keep your strategy and system running at full capacity, full cylinders, and all cylinders, right? And it's important to understand that even as a systems trader, a mechanical trader, someone using indicators, you still have to be a good analyst. And some people or many people flock to the mechanical side because it seems easier, right? It's a lot easier to train yourself to look at a moving average crossing another moving average, or train yourself to see an RSI go to a certain level versus training yourself to read the ebbs and flows of price action. So they look at it as a shortcut, a quote unquote easier way to trade. But the truth is this, and I ask yourself this question: what are indicators based off of, right? Do indicators project price action, or are indicators lagging behind price action, right? Does an indicator tell us what price is going to do next, or does price tell us what the indicator may do next, right? The answer is the latter, right? Indicators are lagging. They are going to be reactive to what happens on a price chart. So everything that you see on your indicator, whether it's an on-chart indicator such as Bollinger Bands and Keltner channels, whether it's a below-chart or off-chart indicator such as an RSI or a stochastics, it is all based off of what's happening on the price chart. So to better understand your indicator means to better understand price. And better understanding your indicator is something that I preach all of the time. Again, I am a mainly price action trader. Structure is the centerpiece of my trading philosophy. I do use an indicator. I use an RSI, I use an ATR. I've developed strategies in the past that used different indicators as well. And the key is, right, I've also, a very, very long time ago, I was that trader that had 100 indicators on his chart, because every time I'd YouTube search something that looked cool, I would plug it in and think the more, the merrier. But over the years, I learned a very valuable lesson that if you are going to use an indicator, you need to know what your indicator indicates, right? Many traders out there are using indicators, but they don't actually know what it tells them. They don't know if it's a momentum indicator. They don't know if it's a, I hate this term, a quote unquote reversal indicator, right? They don't know what their chart or what their indicator is actually showing them. They don't know how their indicator actually works, and therefore they are using their indicator the wrong way, or maybe not optimizing how they use it. So first and foremost, if you're going to be a mechanical trader that uses an indicators, it's important to know what your indicator measures, why your indicator works. And understanding that means that you understand what is happening on the price chart that is causing your indicator to do this or to do that. So it just goes back to the first concept, right? If our goal is to do post-market analysis, to consistently analyze how our strategy is performing, consistently perform reviews in the market to see what is changing. Is volatility rising? Is volatility lowering? Is the market in more of a consolidative state? Is it more of in a directional state? Are we breaking out? Are we doing a lot of fakey stuff like that? If we're consistently paying attention to the markets and understanding what price is doing and staying up to date with how things are moving, that is going to allow us to see what changes, what shifts do we need to make to our indicator. And some of the shifts are going to be the smallest things, right? Changing the settings. I don't know if you've ever done back testing using indicators on different pairs, but because different pairs move differently, right? We always say that each pair in Forex is like its own employee, right? They have different personalities. You may have to have different settings on each indicator that you use for different pairs. Your setting for the MACD on the euro dollar may be completely different than one on the dollar Canada. One is a lot more directional than the other. One is a lot more consolidative. So you may need more of a lagging indicator on the euro dollar because you don't want to get faked into this consolidation. You may have a sharper, more reactive one on the dollar Canada because you know that, hey, boom, once we go, we go. And when the trend happens, it happens quick. So again, understanding price allows you to understand how you're going to adapt and adjust the settings to your indicator. So to answer this trader's question, it does go back to being a good chartist. It does go back to being a good analyst. It does go back to doing all of the other things that we spoke about before, about post-market review and continuing to take notes and track and journal. And even though you may not specifically be trading quote unquote price action, If your indicator is based off of price action, well, then in a way you are. Hope you guys enjoyed the podcast. If you want to learn more about how to advance your skill in the market, make sure you check out the content available at www.tier1trading.com. Of course, the premium courses are going to be your best bet, but before making any type of commitment, I would dip a toe in. Make sure that we are the right teachers for you. Make sure what we're teaching and our teaching style, I should say, hits home and it's understandable and it seems like it's the right fit. So check out that 14-day trial membership. Again, www.tier1trading.com. Check out the 14-day risk-free trial membership first. Make sure we're the right fit. Then dig in and start your path on becoming a consistently profitable trader.